Glad you're here. If you are 65 or older, there are taxes and bills you legally stopped owing the day you hit that birthday, and right now most of you are still paying them in full. I am not talking about pennies. I am not talking about clipping coupons to save 50 cents on a can of soup. I am talking about real money. $5,000, even $10,000 a year that the IRS, your county government, and Medicare are still collecting from people who do not owe it anymore, not because you did anything wrong. The system simply is not built to tell you, and almost nobody does. Here is what makes this urgent. Some of these breaks are deductions you just have to claim on your tax return, and if your preparer misses them, you eat the difference. Some are programs your state runs, but will never enroll you in, and at least one of them has a filing deadline that comes around every spring. And if you miss it, you lose that break for the entire year and have to start over from scratch. Every tax season, every month you wait is money out of your pocket that you do not get back. Think about what an extra $5,000 a year is on a fixed income. That is months of groceries, every utility bill you pay, a year of car insurance, and gas. It is the difference between a budget that is tight and one that breathes. And for a lot of people watching this, that exact amount is sitting unclaimed right now. I went through the federal tax code, the 2026 numbers, and the rules across all 50 states, and I am going to walk you through 5 things that stop at 65, exactly who qualifies, and the one step you take to claim each one. Stay until the end, because number 5 is the one with the deadline, and for homeowners, it could be the biggest of all. Before we start, if you are not subscribed to this channel, hit that button right now and turn on notifications. The tax brackets, the deduction amounts, and the income limits on these programs change every single year, and when they change, nobody from the IRS or Medicare mails you a letter explaining it. They adjust the rule and expect you to already know. People subscribed here find out in time. The ones who are not usually find out at tax season too late, after the deadline, after the return is filed, after the money is already gone. The first one is the simplest. It is the one nobody thinks to check. When you turn 65, the standard deduction on your federal tax return gets bigger. Not the regular standard deduction everybody gets. An extra slice stacked right on top, just for being 65 or older. For 2026, the base standard deduction is $16,100 for a single person and $32,200 for a married couple filing together. On top of that, if you are 65 or older, you add another $2,050. If you are single, or $1,650 for each spouse who qualifies on a joint return. There is no application, no form, no income limit. It does not matter if you live on $20,000 a year or $200,000. The only way to lose it is to fail to claim it. People lose it every year by letting a preparer rush the return or by checking the wrong box in their tax software. So here is your step. Pull your most recent tax return, find the standard deduction line, and make sure the higher amount for people 65 and older is the number sitting there. If it is not, that is tax you overpaid. You can amend the return up to 3 years back and get it returned to you. If you just checked that and figured you were done, stay with me because the law changed in 2025 and added a second deduction that is much bigger, and a lot of preparers have not fully caught up to it yet. Tax law Congress passed in 2025 created a brand new deduction just for people 65 and older, worth $6,000 per qualifying person every year from 2025 through 2028. That sits on top of the regular standard deduction and on top of the extra 65 deduction I just walked you through. For a married couple where both spouses are over 65, that is $12,000 of additional deduction. In a 22% tax bracket, $6,000 of deduction is about $1,320. That stays in your pocket instead of going to the IRS. Here is the trap, And it is the reason I am telling you to watch your income. This one phases out. If your income for tax purposes climbs above $75,000 as a single filer, or $150,000 for a married couple, the deduction starts shrinking, and a large required withdrawal from your IRA, or a Roth conversion, can shove you over that line without you ever noticing. So the step here has two parts. Make sure the deduction actually shows up on your return, and if you are anywhere near those income limits, time your withdrawals so you do not accidentally deduct yourself right out of it. The first two were about deductions on paper. This next one is different, and it is for anyone who has a traditional IRA and gives any money at all to a church or a charity. If you are 70 and a half or older, with a traditional IRA, there is a move called the Qualified Charitable Distribution, the QCD, and it is one of the most powerful and least used breaks in the entire tax code. Here is how it works in plain terms. Instead of writing a check to your church out of your bank account, you tell the company that holds your IRA to send that money directly to the charity. You can move up to $111,000 this way in 2026. And here is what makes it special. That money never shows up as income on your tax return. Not on the income line, not anywhere. You give the same amount you were already going to give. You pay zero federal tax on a single dollar of it. A lot of people believe a charitable gift only helps at tax time if you itemize. That is the belief, and the QCD breaks it cleanly, because this works whether you itemize or take the standard deduction. There is a second payoff most people never see coming. Keeping that money off your income line can lower how much of your Social Security gets taxed, and it can hold you under the income limits for those other breaks we just covered. The step is simple, but the details decide whether it counts. Call the company that holds your IRA, tell them you want a qualified charitable distribution sent straight to the charity, and make sure the check is made out to the charity and not to you. Then tell your tax preparer in writing, because it has to be reported correctly on your return, or you lose the whole benefit. Now we get to the bills, the ones pulled straight out of your check every month before you ever see the money. Number 4 is your Medicare Part B premium. Every month, Medicare takes $185 out of your Social Security for that premium. That is $2,220 a year, gone before the deposit ever lands. Most people just accept it as the price of being on Medicare and never question whether it has to be that way. What they do not know is that there is a set of programs called Medicare Savings Programs run by your state that will pay that premium for you in full every single month. The most complete one is the Qualified Medicare Beneficiary Program, QMB, and it does not stop at the premium. It also picks up your deductibles and your co-payments. If your income is below roughly $20,300 a year, as a single person, there's a strong chance you qualify, and there are higher tiers that cover the premium alone for people who earn a little more. Now, you might be thinking your income is too high, that this is only for people with almost nothing. Maybe, but the limits are higher than most people guess, and they change every year. The only way to actually know is to run your number rather than assume. People talk themselves out of $2,000 a year on a guess. Here is the part that ambushes people. This is a federal benefit, but it is not automatic. Nobody enrolls you. Even if you qualify on paper today, you will keep paying that premium every month until you apply for it yourself. So the step is to go to benefits.gov or call your state Medicaid office and ask to apply for a Medicare Savings Program. It takes about half an hour, and it can put that $2,200 a year back where it belongs. And number 5 is the biggest of all, especially if you own your home, and it is the one with a deadline that quietly disappears on you. If you are 65 or older and you own your home, almost every state in the country has a property tax break waiting for you. A senior exemption, a senior freeze, or a credit that lowers the taxable value of your home, caps how far your bill can climb, or freezes it right where it is. Depending on your state, and your home, that is worth anywhere from $2,000 to $8,000 a year. For a lot of people, that is a couple of months of groceries and every utility bill for the entire year. It is the biggest single number on this whole list for most homeowners. And it is also the one with the catch that costs people the most. In most states, you have to apply, and there is a deadline, usually somewhere between January and the spring. Miss that deadline, you lose the exemption for that entire year. It is not retroactive in most places. You do not get it back. You wait. You apply again next year, and you pay full freight the whole time in between. The exact rule depends on where you live. In the state of Texas, the over 65 exemption knocks $60,000 off the value your school district is allowed to tax, and it freezes that school tax amount so it never climbs again. In Florida, many counties offer an extra senior exemption for homeowners under a household income limit, and you generally have to file by the 1st of March. In New York, the senior citizen homeowners exemption can cut your assessed value by anywhere from 5 to 50% depending on your income, and in most counties, you have to renew it every single year, or it lapses. To find yours, go to your county assessor or county appraiser website and search for Senior Exemption 2026, or call their main number and ask one specific question whether you have to reapply each year. A lot of retirees assume it renews on its own, and they quietly lose it the year the county stops accepting late applications. Let me show you how this actually happens to a real person. Beverly Callahan is 67, retired high school librarian in Texas. She spent 33 years at the same school, started as a library aide back in 1988, and retired as the head librarian. She did everything right. She funded her retirement account from the 90s on, she paid off her house, and she never missed a property tax payment in 34 years of owning it. The house is paid off now, worth about $340,000. She lives on Social Security and a small pension, around $30,000 a year. Beverly turned 65 in 2024. Nobody called her. Her county never sent a letter. Her tax preparer never once asked her about a charitable transfer. So for 2 full years, she kept paying her property taxes in full, kept claiming the plain standard deduction, and collected none of the breaks she had already earned. Then her neighbor Roberta, who is 71, was applying for something else online and stumbled onto the Texas over 65 exemption completely by accident. Roberta called her that same afternoon. Beverly sat down and added it up. Between the property tax exemption she had skipped and the deductions she never claimed, she had left about $5,000 on the table in just 2 years. The money had been hers the whole time. The only thing standing between her and it was a form she did not know she was supposed to file. So let us bring it together, because each of these comes down to one step. First, the extra standard deduction for 65 and older. Check your tax return. Make sure the higher amount is the one sitting on the line, and amend up to 3 years back if it is not. Second, the new $6,000 senior bonus deduction that runs through 2028. Confirm it is on your return, and watch your income if you are anywhere near the limits. Third, the Qualified Charitable Distribution. If you are over 70 and a half and you give to charity, send the gift straight from your IRA, so it never gets taxed, and it keeps your income down. Fourth, your Medicare Part B premium. Apply for a Medicare Savings Program at benefits.gov and let your state pay it for you. And fifth, the big one, your property tax. Search your county name and senior exemption, find your deadline, and file before it passes. None of these come looking for you. The IRS, your county, and Medicare will keep collecting until the day you tell them to stop, and telling them to stop is one form, one phone call, one box on a return. That is the only thing standing between you and the money. If this helped you, subscribe and send it to someone you know who is 65 or older or owns a paid-off home. One conversation could be worth thousands to them. I will see you in the next one.